What if I told you that everything you know about money is wrong? That the rich don't fear debt, they use it as a powerful tool to create unlimited wealth? While most people avoid loans like the plague, the wealthy actively seek debt and turn it into cash-generating assets. But how exactly do they do it? And more importantly, how can you apply these strategies to build wealth, even if you're starting from zero? Stay with me because, in this video, you'll discover the secrets of how the rich use debt to get richer and how you can too. By the end of this video, you'll know the exact steps to stop seeing debt as a burden and start using it as a wealth-building machine. The myth of debt is bad. For decades, we've been taught that all debt is bad, that if you want to be financially free, you must avoid loans, credit cards, and anything that isn't cash. But here's the secret. The rich don't avoid debt, they control it. Good debt versus bad debt. Bad debt, credit cards, car loans, high-interest loans. Good debt, real estate investments, business loans, stock market leveraging. What if I told you that debt isn't the problem? The real issue is not knowing the difference between bad debt and good debt. Bad debt, high-interest credit card debt, car loans for non-income producing cars, payday loans and unnecessary borrowing. Good debt, real estate loans for rental properties, business loans to scale companies, low-interest investments that generate higher returns. Let's break it down further. Imagine two people, John and Alex. John works hard, saves money, and avoids debt at all costs. He buys a car in cash, rents an apartment, and never takes loans. On the other hand, Alex takes a different approach. He leverages debt to invest in assets. Who do you think becomes wealthier in the long run? If you guessed Alex, you're absolutely right. Why? Because wealth isn't just about saving money, it's about using money wisely. How the rich use debt to make millions. Let's talk about how the wealthy actually use debt to multiply their money. Here are 3 powerful strategies they use and how you can apply them today. Strategy number 1, leveraging real estate debt. What is leverage? Leverage is like borrowing money to make bigger investments. Think of it this way. You have $1,000, but you want to invest $5,000 in stocks. A broker lends you $4,000 so you can invest more. If your stock goes up, you make more money than if you had only used your $1,000. But if the stock goes down, you lose more money too, and might even owe the broker. Leverage equals bigger gains, but also bigger risks. For example, meet Sarah, a real estate investor. Instead of buying a house outright, she puts down $50,000 as a down payment on a rental property worth $500,000. The bank lends her the remaining $450,000. Over time, tenants pay the mortgage through rent, and the home increases in value. After 10 years, the house is worth $700,000. Sarah has made $200,000 in appreciation, all while using the bank's money. Strategy number 2, business debt for scaling. Scaling a business means growing it bigger, like opening new locations, hiring more staff, or upgrading equipment. But growth needs money, and sometimes businesses don't have enough cash on hand. That's where business debt comes in. Instead of waiting years to save up, businesses borrow money, take on debt, to grow faster. Types of business debt for scaling small business loans. Banks or lenders give businesses a lump sum to expand. Businesses pay it back with interest over time. Business lines of credit, like a credit card, but for businesses. You borrow what you need, pay it back, and can borrow again. Venture debt. If a startup is already making money, investors may lend money instead of buying shares to help it scale. Equipment financing. Instead of paying all at once for new machines, businesses finance them and pay in smaller monthly installments. Pros and cons of business debt. For scaling pros. Grow faster, no waiting years to save up. Keep ownership. Unlike investors, lenders don't take a percentage of your business. Build business credit, helps when you need bigger loans later. Cons. Interest costs. You pay back more than you borrowed. Risk of debt. If the business struggles, it may be hard to repay loans. Credit score impact. Defaulting on debt hurts future borrowing power. A typical instance is Amazon, Apple, and Tesla all took on massive debt to grow. Jeff Bezos took out $300,000 in loans to start Amazon. The reason? Debt allows you to scale fast without risking your own capital. Example of scaling with debt. A coffee shop is doing well, but has long lines and not enough space. The owner takes a $100,000 loan to open a second location. Sales double, profits increase, and the loan is paid off with earnings. Now the business is bigger and more successful than before. This is good debt because it helped the business make more money in the long run. Strategy number 3, borrowing to invest in stocks. Margin investing. Even in the stock market, investors use margin loans to buy more shares than they could with cash alone. If done wisely, this can lead to massive returns. How to use these strategies, even if you're broke. So how can you use debt to your advantage? Here's a step-by-step guide to start applying these wealth-building tactics today. Step 1. Fix your credit score. Pay off bad debt first. Keep credit utilization below 30%. Step 2. Use debt to buy income-producing assets, real estate rental properties, investing in cash flow businesses, stocks with dividends. Step 3. Avoid bad debt traps. Never borrow for depreciating assets. Avoid high-interest personal loans. If you follow these steps, you'll be ahead of 90% of people who only see debt as a burden instead of an opportunity. Now that you know how the rich use debt, the real question is, what will you do with this knowledge? Will you keep avoiding debt, or will you start using it strategically to build wealth? The choice is yours. Chapter 4. How to use debt without destroying your business. Not all debt is bad, but if used incorrectly, it can crush a business. So how do successful businesses use debt wisely? Rule number 1. Only borrow for growth, not survival. Debt should be used to increase revenue, not just to cover losses. Example. Good debt is borrowing to expand a store that's already doing well. Bad debt is borrowing just to pay rent when sales are declining. Rule number 2. Calculate return on investment, ROI. Before taking on debt, ask, will this investment bring in more money than it costs? If a loan costs $50,000 with interest, but expansion brings in $200,000 in profit, it's a smart move. Always ensure the profit outweighs the loan cost. Rule number 3. Maintain a healthy debt-to-income ratio. Businesses shouldn't spend more than 30 to 40% of their revenue on debt payments. High debt equals stress plus less flexibility when the economy shifts. Rule number 4. Choose the right type of loan. Short-term loans, good for quick upgrades. Long-term loans, better for large expansions. Lines of credit, best for unpredictable expenses. Chapter 5. The businesses that scaled successfully with debt. Amazon. Jeff Bezos took on debt and reinvested aggressively to dominate e-commerce. Tesla. Elon Musk used billions in loans to push innovation, which later paid off massively. McDonald's expanded rapidly by financing new locations instead of waiting for cash flow. What do they all have in common? 1. They borrowed strategically for growth. 2. They reinvested profits back into the business. 3. They didn't let debt exceed their revenue potential. Chapter 6. The risks of scaling with debt and how to avoid failure. Risk number 1. Overborrowing without a plan. Some businesses take on too much debt and struggle to pay it back. Solution. Always have a clear repayment strategy before borrowing. Risk number 2. Economic downturns. If sales drop due to a recession, businesses with high debt suffer the most. Solution. Keep an emergency fund to cover loan payments for at least 6 months. Risk number 3. High interest rates. Business loans can have crazy interest rates if credit isn't strong. Solution. Shop around for low-interest lenders or consider government-backed loans. Chapter 7. Should you use business debt to scale? If used correctly, debt can be the key to scaling faster. But if mismanaged, it can bankrupt a business. Before borrowing, ask yourself, is my business already making money? Will this loan help me earn more? Do I have a plan for repayment? If the answer is yes, debt can be a powerful tool. If not, it may be better to wait until the business is stable. Now that you understand how businesses use debt to scale, what's next? Do you think debt is a smart tool for growth, or is it too risky? Drop a comment below. Don't forget to like, subscribe, and turn on notifications for more finance insights.